Yep. All right. Well, let's get started. And I just want to say welcome to everybody. Thanks so much for joining us today. Dan and I will be talking about retirement plans for the self-employed. And I'll introduce myself. I'm Amy Akmoody. I'm an associate wealth advisor here at Flagstone Financial Management. And I'm joined by lead wealth advisor Dan Staus. If you don't know much about Flagstone, we're a fee-only comprehensive financial planning firm. And one of our top values is education. So we enjoy doing these office hours presentations to just choose topics that might be relevant to clients and education beyond even our client base. We're happy to be a resource for that education. So we'll discuss our topic today. If you have questions, we'll have some time after our presentation for you to type in questions that are relevant to anything financial, and we're happy to discuss those. I will also give a brief disclaimer. Flagstone Financial Management is a registered investment advisor. Information presented is for educational purposes only and does not intend to make or offer a solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies we discuss. Past performance is not indicative of future performance. There we go. Dan, are you ready?
Yeah, let's get to it.
All right.
A lot of what we have today is, we're going to cover like the most common types of retirement plans that we see a lot of clients using and that we think are appropriate for a lot of the clients who we're serving, at least. And self-employed people are a big portion of who we serve. We kind of have three types of clients who we tend to work with, and one of those three is self-employed individuals. And so we're going to cover like really high level pros and cons, advantages and disadvantages of each of these types of plans. We're not going to get into nitty gritty. Like, number one, this is going to be 15-20-minute overview, and that's not nearly enough time to cover the details. Number two, we wrote blog articles on each one of these types of retirement plans leading up to this. So if you visit our website, flagstonefm.com/blog, or just go to our homepage and then click the menu that says blog, you can see details on each of these plans if you want the details. And then thirdly, even if we did have time and we hadn't written blog articles, the details are just incredibly boring to work through. Now, I know that some of the registrants were CPAs. So for those of you who are CPAs, you probably have more appetite for the detail than most, but even so, that would make for an incredibly dry presentation. So today we're just going to cover like some of the pros and cons. And then for the specific numbers part of the rules, you can refer to other resources. You'll also, the last thing I'll mention kind of as a precursor is you're going to see some flow charts throughout this presentation. You're not going to be able to like take notes and write these things, recreate these flow charts through note taking. So if you want any of the flow charts, just drop us a comment in the chat and say, I'd love the Roth contribution eligibility flow chart or whatever it is. We'll also be recording this and publishing it to YouTube so you can view it there as well. So I just want to let you know, don't bother taking notes for these flow charts. They're really complex. We can get them to you in other ways. So with that, I'm going to share my screen here. And we'll get started. Okay, so the first one we're going to briefly touch on is traditional and Roth IRAs. And part of the reason I'm starting with this is because it's really not actually a retirement account that's specific for self-employed people. Anybody can have a traditional and Roth IRA. Anybody can contribute as long as you have earned income. But you can do that if you're self-employed or working somewhere else. There's a lot of restrictions to these. regarding whether you can contribute to a Roth and also whether you can deduct a contribution to a traditional IRA. Those restrictions are primarily income related restrictions. But the reason I start with this is because it is kind of a good entry-level retirement account for the person who's just getting started, who doesn't have a ton of cash flow yet, but they want to put away a little bit of money for retirement. The advantages are that they're super easy to open, they're super flexible. You can open one almost anywhere, including with us. You can even open one at a small town bank and throw the money in a CD. It's not great for accumulating, but my point is almost everybody has one. Any financial institution. They're super simple, they're low cost. The downside, the number one downside is the low contribution limits. So sometimes you might not be able to put any into a Roth IRA, like I mentioned earlier, if you're over the income limits. And best case scenario, you can only put $7,000 in. So for someone who's making, $200,000, $300,000, that's just not probably going to be enough to be your primary retirement plan savings vehicle. And then there's also little to no tax advantages for new contributions for high earners. So if you are in a high tax bracket, and you might not be able to deduct the contribution to a traditional IRA, and you only get tax-deferred growth then. So it's not super effective. But these are great accounts for, like I said, the people who are just starting out. They're also great accounts for like catching or housing all the contributions that came from other accounts throughout your life. So as you're moving through life and you might be moving careers and changing employers, you can kind of consolidate all those accounts into a traditional or Roth IRA. So they're great for that purpose. This is a chart about whether you can contribute to a Roth. I mentioned that there's limits there. It depends on how much you make, what your tax filing status is, whether you even had earned income for that year. So it's sometimes you can't do anything. Sometimes you can do upwards of 7,000 if you're old enough. And then can you deduct the IRA contribution to a traditional IRA? Again, it's complex. You might be able to do upwards of $7,000, might not be able to deduct anything. You can always put money in a traditional IRA. If you made $1 million that year, you can put money into a traditional IRA. You just can't deduct it if you made too much. So again, depends on how much you made, depends on whether you're a participant in another plan or whether your spouse is. Again, it's complex, but those are some things to think about. SEP IRA is kind of the next level up. So they're also really easy to open. They're simple, they're low cost. What you put into a SEP IRA reduces your current tax bill. It's not like a Roth that has tax-free growth. And contributions are optional each year. So how much you can contribute depends on your compensation, your business profits. So sometimes you can contribute a lot if you pay yourself a decent salary or if you had decent business profits in a given year. But a disadvantage is if you don't show much profit in a given year, you don't pay yourself much of a salary, then you can't really contribute much to a SEP IRA. Even if your cash flow is strong, but maybe your profitability was low, you might not be able to put much in a SEP IRA. There's no Roth option is another disadvantage. If you have employees, you have to make the same contribution percentage-wise to all your employees and including yourself. So you can't put like disproportionately more away for retirement for yourself compared to your employees. Now, employees have to be eligible. There's rules around what's considered an eligible employee. But my point is, you can't, you have to be bought into the idea of contributing to your employees if you have a SEP IRA and you have employees. Let's see. I mentioned the no Roth option. Oh, I don't think I mentioned the other advantage is contributions are optional each year. So if in years where you don't have strong cash flow, even if you have, 10 other employees, you don't have to contribute to theirs. It also means you're not going to be able to contribute to your own SEP IRA But, if it's flexible in the sense that if you're strapped for cash in the business in a given year, you don't have to put money into it. Simple IRA, they are also pretty easy to open. They're also pretty low cost. I mean, when I say low cost on any of these, it depends on the provider, but there are low cost options in these spaces. So, simple IRA, it's easier than a group 401k, than like a full-blown 401k when you have several employees. Simple IRA is a little easier to administer. This one allows employees to contribute. So the SEP IRA does not. And then the traditional and Roth IRAs, they're just your own personal IRA. They're not a group thing. So a simple IRA does allow employees to contribute. So that can be a plus for a lot of business owners who want to allow their employees to put money into it. Higher contribution limits compared to SEP IRA, usually, I should say usually. And, again, like some of the other retirement plans we've already talked about, the pre-tax contributions, they're always pre-tax contributions, and they lower your current tax bill. And then like the other pre-tax contribution accounts, the contributions are grow tax deferred. The disadvantage, it's not really as simple or easy as a SEP IRA. A SEP IRA is a little simpler, which is kind of ironic because the name of this is literally simple IRA, and yet it's not as simple as a SEP IRA. And then, compared to a 401k, there's usually lower contribution limits. So as the employee, you can usually put away more in a 401k. Plus, when you have a 401k, there might be a profit sharing component. You can stuff away even more. Profit sharing component is like the SEP IRA, really. I'll get to that in a couple of slides, but they're not quite as easy as a SEP, and they have lower contribution limits than a 401k. So there's kind of a sweet spot for where simple makes sense. There's no Roth option, whereas there is a Roth option for a 401k, depending on the provider. And then lastly, contributions are required. So you're going to elect to either contribute 2% to all your employees or to match what they contribute up to 3% of their salary. So kind of depends on whether you want to incent your employees to contribute. And if you want to do that, then you also are on the hook for a little more if they do choose to contribute. Or the 2% flat for all employees, then the maximum you're going to have to do is 2%, but you're also doing a minimum of 2%. So it kind of depends on your goals there. So that is primarily a differentiator between the SEP. So the SEP, again, is optional contributions each year. The simple, you're going to be required to contribute to employees each year. Here's another flow chart. I just want to kind of make you aware that this is a flow chart that's available. I'm not going to go through it, but a lot of times business owners who have employees are oftentimes considering a simple IRA versus SEP. Both plans allow employees to benefit from them. They're both easier to administer and lower cost than a 401k. So a lot of times business owners are trying to decide between these two. It really depends which one is best, depends on how many employees you have, whether you want the employees to be able to put money in it themselves, or whether you just want to be the only person putting money in, and how much you want to contribute dollar-wise. So all those things, kind of the answers to those questions kind of lead us to a recommendation typically. The other big one that we see, and this is the last common one that I'm going to mention, and then I'm going to end with an uncommon one. This last common one is called a solo 401k, which the rules are mostly like a normal 401k, except a solo 401k is a little simpler, and it's only for businesses who have the only employees of the business are owners and their spouses. If you have any non-owner employees, you can't have a solo 401k. So this is for like, the business owner who doesn't have employees, or maybe they're paying their spouse because their spouse is making some sort of contribution to the business as well. Or maybe it's two people who own a business together. Solo 401k could be a good option. Why is that? Why is it better than any of these others? Well, it's got higher contribution limits with lower profits required, lower compensation required. So you can do more with less income with the solo 401k compared to the SEP and compared to the simple. Contributions are optional. The pre-tax contributions lower current tax bill, and then Roth contributions provide tax-free growth. That's another advantage over other plans, is that solo 401ks actually have a Roth option. So it's one of the only ways that you can add or accumulate more Roth dollars when you're a high earner. Because oftentimes you won't be able to put it in a Roth IRA, but a Roth 401k doesn't have income limits to that. So it can be really powerful for people who are trying to accumulate more Roth dollars. The disadvantage is they're slightly more complex than other plans, and they're slightly higher cost. And then I already mentioned the second disadvantage there. They're only for businesses where the only employees are owners and their spouses. So, it's a smaller subset of clients. It's a lot of our clients, but in the bigger picture of business owners, this is a smaller group of people who could have or be eligible for the solo 401k. But they really are, like, sometimes people think 401k, oh my gosh, it's expensive, it's complex. A solo 401k, at least with the administrator that we use, they can be really easy, and it actually really reasonably priced too. Like a couple $100 a year is all it costs currently. That could always change, but yeah, really, it can be really easy for the right client. And yeah, those contribution limits are just really higher than the other plans that I've talked about. So that's the last common one. I told you I'd end with an uncommon one, and I'm kind of doing rapid fire here, so hopefully you're following along. But this cash balance plan is the last one I'd mentioned. It's actually a type of pension. There are 4 types of pensions, and this is just one. I'm not going to talk about the others, but this is one that is more common, particularly in the last 5-ish years because of some tax law changes. So why am I even talking about this? Well, there are some specific business owners out there who have really high cash flow. They've already kind of maxed out other tax savings vehicles, and they're looking to get even more money stuffed away. The other qualities of people who would be characteristics of people who would really benefit from cash balance plans, they're typically over like 40, 45-ish, and they have either very few employees or their employees are very young. For those really specific set of people, cash balance plans you can get a ton of money stuffed away in a cash balance plan that's tax deferred. It's lowering your current tax bill. And so like the contribution limits are not coordinated with other plans. You can have a 401k that you're maxing out and also have a cash balance plan. The way that it works is you're kind of trying to, like, underline how it works is you're trying to create, the plan document at least is stating that you're trying to create a certain amount of income in retirement. So in order to create that, an actuary says, well, in order to have, let's say $200,000 of income later in life, you have to put in right now 300,000 or 50,000 or whatever the number is that they calculate using various formulas and using your age and years of service, all that stuff. They say, okay, here's how much you can contribute in this year. And whatever you contribute then for each of your people is how much you can deduct. This is a total home run for people who are in certain types of businesses. And for the people who aren't CPAs, you can tune out for the next 20 seconds. For the people who are CPAs who are watching, you are probably familiar with QBI deduction. There are people in certain types of industries who can't claim the full deduction if they make certain amounts. Well, if you contribute to a cash balance plan and you're in that stated business, it can lower your income to the point where not only are you getting a deduction on the contributions, but you're also lowering your income enough to then make yourself eligible for a QBI deduction that you wouldn't otherwise have been eligible for. So the tax savings can add up to like 50% plus if you consider all those other secondary effects of it. So it can be super advantageous. For again, you have to have high cash flow. It generally makes sense for older individuals. When I say older, I just mean 40 plus. Probably not great for the 25-year-old self-employed person, but anyway, it's expensive, it's complex, but for the right client, that tax savings can kind of dwarf those expenses and highly make up for the complexity. So that's the last one I thought I'd mention. In the invitation that we sent out, we listed a couple of FAQs. And here's what they were. So what retirement plans allow the highest contributions? Really depends of the common ones. It's the solo 401k. Is there a retirement plan I can contribute to in some years and not in others? SEP IRA and solo 401k would be the ones. Actually, traditional and Roth IRAs too, if we're thinking about those. Do I have to contribute for every employee? Depends on the plan. For the simple and the SEP, you do. If you have a group 401k, which we didn't even talk about that, but on group 401ks, you have to contribute for your employees as well. And cash balance plans, you do. What plan offers the best tax advantages? That's subjective, but I really like the solo 401k because it has the Roth option, has high contribution limits. So if you're doing pre-tax, you can usually get a lot of tax benefit from that too. Current tax benefit. Cash balance plan, I'm not really including as a candidate since it's less common, but those are some rapid fire answers to those questions. So again, this was super big picture. I went super fast, but hopefully if I want to conclude this by saying, if you're a client of ours, you don't feel like your job is to know all these rules. Like that's what you're paying us to do. You're paying us to know the rules and then offer you a recommendation. So the conversation with us should be, hey, I want a plan that does this or that accomplishes these goals. And then we can take that information, think about all the options and give you a recommendation. If you're not a client, hopefully this gave you enough information to kind of lean in a certain direction and then talk to your CPA, talk to your financial advisor, or if you don't have an advisor, reach out to us if you're interested in becoming a client or want help with this specific question, and we can kind of quarterback that for you. So yeah, if you feel overwhelmed, that's okay. We're here to do the heavy lifting of helping you make a decision. So with that, there's a disclosure that Amy read. I think that's all I had for the meat and potatoes of the discussion. So let's open it up for questions. You can drop a question in the Q&A box. Amy, do we have any yet?
Yeah, we do have some questions. And first of all, Dan, thanks so much for the information because it's great information. And what you said at the end is what was kind of going through my mind as well. The complexities of these plans can be a lot. And so, yes, please do reach out to us if you have questions or your CPA as well. But we'll move into questions. And one of the things that is on a lot of people's mind that came in is the market. So the question is, can you address the market drop? Dan, would you be willing?
Yeah, I guess that's a good reminder. Like you can ask questions about anything. That's what the point of kind of office hours is, to say, hey, stop in and ask us anything that's on your mind. So yeah, the stock market's on a lot of people's minds. I have some charts that I can share actually related to this. So the stock market drop sucks. I mean, it sucks losing money. There's no way to sugarcoat that. So I acknowledge that. Just trying to share my screen here. There we go. It's also kind of relative. So we're in this interesting period where the recent peak was at the beginning of the year. So many people focus on year-to-date returns. And from that perspective, it looks awful because the peak was on like January 3rd. So, we're down, like the S&P 500 is down about 22% since the January peak. I would also point out that since the pre-COVID peak, this S&P 500 is actually up 11%. And since the beginning of 2019, just 3 years ago, the S&P 500 is up almost 50%. So just keep some perspective as long-term investors, which is primarily who we deal with and who we are at our core. Long-term investors, the 9-month returns are meaningless. Really, even expanding our view to 3 years is kind of meaningless. When we look at the long-term time horizon of stock market returns, this is kind of a blip. And, we're seeing really attractive valuations right now, meaning if you have extra cash, a lot of folks, for a lot of folks, not for everybody, but for a lot of folks, it makes sense to be buying into the stock market right now, knowing that we could continue to see a sell-off. We really don't know what's going to happen in the short term, but in the longer term, it's a pretty good time to buy. To that end, I'll show you one other. Actually, I think it's on this side. Yeah, one other chart related to that. This is a super busy chart, so I'm not going to try to point you to any specific thing on this chart, but what it means is the valuations in the stock market, they are a really poor determining factor of what short-term future returns are going to be. In other words, in the next valuations are attractive right now, but that is almost meaningless when you think about what's going to happen in the next 12 months. We could, like I said, we could continue to see a sell-off. Maybe the recovery is going to happen starting Monday. I just don't know. But attractive valuations are a really good determining factor or indicator of what future long-term returns are going to be. So the correlation is really tight, meaning when attractive or when valuations are attractive, that generally means that the next 10-year performance is going to be really strong. And so that's why I say, as long-term investors, if we can focus on longer-term numbers, it kind of paints the current events in a little different light. I don't know if that helps at all. I mean, I don't know what the person asking the question specifically was wondering about, but that's just kind of, for long-term investors, I hope you can be encouraged because there's a silver lining here that doesn't often get talked about. So.
All right. Thanks, Dan. Another thing on people's minds that we've been hearing about is the next question, which asks, do you have suggestions for how I can reduce my taxes? And again, I'll preface this with, you can speak with your CPA about this, but offhand, I'll quickly mention a few. Contributions are a good way to reduce your taxable income or get a deduction. And some of those are through a 529 education account. Some states offer state tax deductions on those. So you'd have to check to see if your state does and the one who's hosting. Another way to reduce your taxable income is through employer retirement plans. You can also, if you're age 70 and a half or older, make a qualified charitable distribution from your IRA. Basically, that's making a charitable distribution from your IRA to a nonprofit. And that helps to reduce your taxable income, as it doesn't count for income received for the year. And then if you have a high deductible health insurance plan, you can make contributions to a health savings account, an HSA. And if the individual limit is $3,650 and the family limit is $7,300. So those are some contributions that you can make for the deduction or the reduction of taxable income. Also, there are some tax loss harvesting things that you can look out for. If you're a Flagstone client, we do that. We watch that for you. And then also keep tax credits in mind. you can educate yourself on that or talk to your CPA. But some common tax credits are the child tax credit or an adoption tax credit, as well as some renewable energy product credits. Dan, do you have any additions to that?
If you're a self-employed person, then you can make sizable contributions to retirement accounts. Depends on the type of plan, but some require it before the year end. Some don't require it until you file. So that's another one to consider. And it depends on the plan, but like if you don't have a current plan associated with your business, then some require you to open them shortly. Others, you don't even have to open them until, like a SEP IRA, for example, you don't even have to open until next April or until you file. So yeah, there's other opportunities there. The HSA I see is a big one that people tend to forget about, seems like, that you mentioned, but I'll just reiterate, a lot of people forget about it.
All right, great, thank you. One more question, and then I think our time is up, but how does inflation affect the stock market?
Yeah, I can take that one. There's not necessarily a strong direct correlation. In other words, like when inflation happens, the stock market doesn't consistently do one thing or the other, particularly in the short term. I will mention that the stock market has historically been one of the best hedges against high inflation in the long term. Again, not in the short term. But and now is a good example. Like you think about, well, we have short-term inflation right now of 7% plus, and the stock market's down. So that's obviously not a good hedge in the short term. But if you were invested 3 years ago, we just looked at that chart where the S&P 500 is up 50% compared to 3 years ago. Well, what's the 3-year annualized inflation number? Well, it's less than 7%. So over that just 3-year period, the stock market has been a really good hedge against inflation. So yeah, there's not a direct causation there that consistently produces the same outcome, but historically the stock market is a good long-term hedge against inflation. So it means different things for different industries too. Like when you look at the individual companies or sectors, inflation does different things to those different sectors. So yeah, it's kind of complex. I don't have any data to put in front of you right now for that, but those are kind of my thoughts. Any other questions?
No other questions. I think that we've wrapped up, and I really appreciate, Dan, the information that you've presented. And we also appreciate you joining us today. If you have any needs or questions, feel free to get a hold of us. Also, if you'd like the charts and slides, feel free to request those from us. But good to have you with us. Thanks for joining us, and enjoy a wonderful weekend. Thanks, everybody.
All right.